Well, speaking of another founder here, on Tuesday, Volvo announced that it would be the latest car company to join Tesla's charging network, following in the tire tracks of Ford, General Motors, and Rivian. But Wall Street is keeping a close eye on the EV leader after some bearish calls. You see a series of recent downgrades of the stock begs the question about Tesla's current valuation and what these partnerships could mean long-term for the company. Let's get another take from ROTH Capital Partners Senior Research Analyst Craig Irwin. Craig, good to have you on the show here. So what do you make of what we've seen here with a lot of these downgrades, but still seeing these raised price targets?
Well, what's going on is that the stock has performed incredibly well this year. There was a very tough ending to last year. They cut prices, and those price cuts were successful in reinvigorating enthusiasm on the sales side. And then you layer in the success of NACS, the Tesla charging protocol standard connector, being adopted by many of the leading OEMs. So, they've had some real wins, and the valuation has taken off like a kite, from close to $100 to 250 plus is a big move. So people are, I believe, just really being reactionary. I've maintained my long-term bearish stance. It's a great company. They played a huge role in transforming transportation, but you've got 100 new EVs coming to market. These big names you mentioned, Ford and General Motors. There's lots of old guard that's coming in with pretty compelling vehicles that I think is going to compete effectively and make it harder for Tesla to see the growth and the margins that they've been achieving going forward.
And I mean, at least for now, Tesla is still dominating versus some of the other EV makers out there. So how sustainable, though, is the demand side of the picture? As you mentioned there, so many more people coming into the fray with potentially cheaper models too.
Yeah, so what's been proven out actually is that demand is really price sensitive. So Tesla's cut certain models as much as 30%. So, consumers respond, when there's big price changes, they do respond. EVs have been expensive because batteries have been expensive. There's been a lot of progress bringing down battery costs, but the capabilities really haven't been improving as quickly as people had hoped. As these things make progress over the next many years, it's inevitable. You're going to see continued fantastic adoption of electric vehicles. But demand is weak. Demand is a little choppy in this environment, which is why Tesla had to go out there and cut prices as aggressively as it did.
And so how do you think sort of getting more partners on board with the supercharging network and that infrastructure and the revenue that might come from that, does that put it perhaps in put a bigger moat around it, I suppose?
Yeah, so they have been roughly 80% of the North American market, dominating globally, and deserve full credit for that. A large part of that success was actually the supercharger network. The Tesla drivers charge on average about 15% of their miles driven on DC fast chargers, on these superchargers. The rest of the EV drivers in North America do about 5%. So their network is something that gives their customers a lot of comfort. So, it's also, a multiple of the size of everybody else's networks, the private networks. So General Motors and Ford and everybody else jumping in and signing these agreements to gain access to that is very positive for them, positive for adoption. We don't know how much their customers are actually going to end up paying versus Tesla customers. And, I think there is some potential impact to the Tesla brand. You're not really going to be enthusiastic sitting online to charge your vehicle behind a great big Hummer. It's going to take 2-3 times as long to fill the battery. So, there's pluses and minuses. They probably do make some money on this, and that's a fantastic thing. That's what capitalism is about. That's what drives investment. But I look at Tesla, I say it's egregiously overvalued, but man, what a fantastic pioneer to drive this industry forward.
I mean, and speaking of pioneering, we have to talk AI here. A lot of big bets coming from the AI side when, Elon Musk talked about, buying more chips from NVIDIA and really trying to get ahead of this. How much of that is also factoring into the fervor, and how much of that is sort of well-founded at this point?
Yes, so the institutional investors usually take that with a grain of salt. I mean, they trade it like retail investors. So there's, retail is a very large part of the trading and trading direction, trading velocity in the stock. But the big institutions all know that, on a relative basis, the importance of AI to Tesla is moderate. The full self-driving capabilities are really a misnomer in my opinion. When you look at the rate of these false stops, the aberrations, when you drive in these vehicles, 1 to 4 or 5 a mile, and you think about those actually causing accidents. um, you know, it's beautiful that they're pushing hard to develop the technology. I just think that others will be more careful in introducing things into the market. And Tesla's going to make other people go faster, but the profit opportunity from this AI, I think, is much more limited for Tesla, at least at the moment.
So then when you're comparing sort of the near-term uncertainty versus longer term, would you say this is more of a bull run or a bull trap? How should investors be looking at this?
Well, it's definitely not a value trap. Maybe a bull trap is the right label. Um, you know, a lot of investors trade as momentum investors and are in this stock, and correctly selling into strength, in my opinion. And then buying on weakness. I'm not against that kind of trading strategy. I do think that if some of these concerns about the battery source for the rear-wheel drive Model 3, their highest volume vehicle, switching away from a Chinese source, that's a question mark. The impact of competition. Some of these other networks quite probably do better on a relative basis on the charging side than Tesla, given Mr. Musk's political posturing. A lot of investors are acutely aware of this and watching closely. And as this evidence comes out, you can expect, some significant volatility in the stock. Goes up quickly, will go down equally as quickly. And we're cautious. We think people should be aware that that's a significant possibility, over the next number of months.
We'll certainly be tracking that. Great having you on. ROTH Capital Partners Senior Research Analyst Craig Irwin. Good to see you.
Thank you.